In the first week of December, Chinese stocks experienced their biggest jump in almost 6 years, up 9.5%. Additionally, daily trading broke through the 1 trillion yuan mark for the first time as more and more domestic Chinese investors began rushing in to open trading accounts at a rate not seen for the past few years. Despite the recent global perceptions of economic weakness in China, the Shanghai Stock Index just continues to soar higher. Shares really caught fire when top global investment guru Mark Mobius, who also serves as an emerging markets fund manager over at Franklin Templeton Investments, chimed in and stated that he believed that the bull market in Chinese stocks was just getting started. You may recall just 5 weeks ago on our November 11th broadcast, I told you that I would be adding significant exposure to Chinese stocks in my own portfolio. That broadcast was appropriately entitled, "It's Time to Buy China." At that same time, I also informed all of our paid subscribers of the specific ETF that I would be using to gain access to China. Now, over the past 5 weeks, many of our subscribers have enjoyed the 27% increase in that Chinese ETF, and I believe that we are still in the early stages of this brand new Chinese bull market. Another top financial institution, Morgan Stanley, also agrees, putting out a report recently that showed several possibilities for the Shanghai Composite Index as we go forward. In the report, they demonstrated that if Chinese stocks simply return to their historical PE ratio of about 21.8, that would give the market about a 70% upside from here. If Chinese stocks simply increase to the same PE multiple as the S&P 500 is currently, about 18.4, then we would experience about a 42% increase in Chinese stocks from here. The report also stated that if Chinese stocks were to increase to their historical peak PE, which was 71.4 back in the bubble phase, this would give the market 453% upside from here. Of course, the current boom in Chinese stocks is coming after the big boom and then ensuing crash of Chinese real estate. This is a pattern we see all over the place, especially here in the United States, where we saw the dot-com bubble, and then, of course, the crash, which was followed by the real estate bubble, and then the real estate crash, and then followed by now another stock bubble, which is no doubt ballooning. Some are concerned about China's economic figures, and of course, if they do continue to deteriorate, investors will likely expect China's central bank to lower reserve requirements and to cut interest rates. Trading country-based ETFs has long been one of my favorite ways to profit from the markets. I like to watch the news and pay attention to what's happening to different countries and then invest in their stocks based upon that. One of the best ways to do that is to use ETFs, or exchange-traded funds. This, of course, gives you broad exposure to many stocks in that particular country without taking on the excessive risk of owning one or two. Right now, there are 2 other country ETFs that I have been watching very closely, 2 other countries that I think that are going to rise fairly dramatically. One of these ETFs that I'm going to buy could return upwards of 100% in less than 24 months, while the other could provide about a 40 to 60% return during that same time period. Now, you know I like to share these with our paid subscribers. If you're an FTM insider, simply check out today's show notes to see which countries I'm talking about, along with the specific ETFs that I plan on buying to make these returns. Remember, you should always do your own due diligence and always talk to a trusted financial advisor before making any investment decision.